Welcome back, everyone. I'm so glad you're joining us for today's explainer because, well, we are breaking down an absolute behemoth in the investing world. We're talking about the Vanguard Total Stock Market ETF. You probably know it best by its ticker, VTI. Okay, let's dive right into this. VTI is literally one of the single most popular exchange-traded funds on the planet. We're talking about a fund commanding over $1.5 trillion in assets. That's trillion with a T. It's basically the cornerstone for millions of retirement accounts and everyday brokerage portfolios. But I've got to ask you a really important question here. Do you know what you actually own when you buy a share of VTI? Because, you might think you have this ultimate, untouchable diversification spread across the entire U.S. economy. But today, we're going to completely unpack the myth versus the reality of total market investing.
Here is our roadmap for the explainer. First up, the big tech bet. 2. VTI versus the S&P 500. 3. Valuations and warning signs. And 4. The final verdict.
Starting with Section 1, the big tech bet, decoding VTI's true holdings. So the headline pitch for VTI is honestly incredibly appealing. It tracks the CRSP U.S. Total Market Index, giving you exposure to over 3,600 different stocks. It's really designed to capture virtually the entire investable U.S. equity market. I mean, on paper, that sounds perfectly diversified, right? It feels like you're buying a tiny piece of everything. But, well, not exactly. And this brilliantly illustrates why. Because VTI is a market cap-weighted fund, the absolute largest companies naturally just dictate its direction. Just 7 stocks make up nearly 29% of the entire 3,600 stock fund. All the other 3,593 companies, they are just crammed right into that remainder.
Those 7 massive slices belong to Nvidia, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. So, you're absolutely not buying 3,600 equal pieces of the economy. You are highly, highly concentrated. Think about it. When Nvidia jumped 11% recently on AI news, VTI went right up with it. But of course it works both ways, right? When big tech sneezes, VTI definitely catches a cold. To put that into perspective, buying into VTI is essentially placing a massive $1.2 trillion bet on big tech. That is the undeniable concentration risk that analysts are buzzing about right now, and it's hiding right beneath the surface of that total market label. Which brings us to Section 2, VTI versus the S&P 500, the drag of diversification. So how has this setup actually played out for investors in the real world? Let's compare VTI side by side with its prominent Vanguard sibling, the S&P 500 ETF, ticker VOO. Both of them feature this identical ultra-low expense ratio of just 0.03%. But take a look at the concentration. VOO only holds 500 companies, so it's actually even more top-heavy, with its top 10 holdings making up about 38% of the fund. VTI is slightly more diluted at about 32%, just because it includes all those mid and small cap stocks. And you know what? That structural difference has profoundly impacted performance. Over the past 1, 5, and 10-year periods, VTI has actually consistently underperformed VOO. Why is that? Well, it's because small and mid-cap stocks have really struggled relative to mega-cap growth. VOO has been absolutely propelled higher by those tech giants, while VTI's huge tail of thousands of smaller companies has acted sort of like an anchor, just dragging down the overall returns. Which naturally leads to the critical question analysts across the financial sector are asking right now. Why own VTI at all if VOO gives you better historical returns with even slightly lower volatility? It's a super fair question. And to answer it, we really need to look at what the current data is telling us. Moving into Section 3, valuations and warning signs, looking under the hood. Right now, VTI is sitting at around $381.78 per share, and that is hovering dangerously close to its 52-week high of $383.29. Now, what's really interesting about this slide is that we're getting some mixed messages from the technical signals here. The Relative Strength Index, or RSI, is sitting at 66. That indicates a bullish trend, but technically it's not overbought yet. However, stochastics are reading above 80, and that flashes a definite short-term overbought warning. And yet, the moving averages are all pointing up, serving as a really strong long-term buy signal. So it's kind of a tug of war, right? Short-term caution versus long-term strength. Looking at the fundamental valuations impartially, the price-to-earnings, or PE ratio, is floating somewhere between 24 and 28. Surprisingly, that's actually 32% below its own 5-year average of 41.4. And the forward PE sits at 19.6, which implies a very healthy expected earnings growth of roughly 18%. But before you go jumping all in, here is the catch. The earnings yield on VTI is currently about 3.6%. Meanwhile, the 10-year Treasury yield sits around 4.6%. Just think about that for a second. You are currently getting paid more to hold risk-free government bonds than you are to hold a basket of U.S. equities. In finance, we call this a negative risk premium. It's an environment where the safety of bonds actually outpays the risk of stocks. Historically speaking, this isn't exactly an outright red flag, but it is for sure a bright yellow one. It's a warning signal to investors that future equity returns might be far more modest than what we've all grown used to over the last decade. Let's move to Section 4 and see how this builds into our final verdict: buy, hold, or sell. First, let's consider what the smart money is doing right now. In the first week of August alone, a staggering $1.8 billion flowed directly into VTI. That tells us institutional money is actively buying the dip. If you're a long-term investor, with a time horizon of 10 years or more, this really reinforces the case that VTI remains a solid core holding. You're essentially placing a long-term bet on American capitalism. And historically, well, that's worked out pretty well. However, if you are short-term focused or maybe particularly risk-averse, the data suggests you might need to actively navigate this tech concentration. You basically have three clear strategies here. Number one, pair a VTI with an equal weight ETF to balance out that top-heavy tech influence. Number two, add some international exposure, like VXUS, to truly diversify beyond the US. Or number three, simply switch your holdings entirely to VOO for slightly lower historical volatility and a leaner mega-cap exposure. So the crucial point is this: VTI is a strong hold for most long-term portfolios. The concentration in tech is just a feature of index investing today, it's not a bug. But with that negative risk premium currently in play, it is absolutely time to manage our expectations. Do not go in expecting the massive 20% annual returns we've seen in recent years. Single-digit returns are far more likely from this point forward. Which leaves us with one final thought to consider for your own portfolio. Knowing what you know now about market cap weighting and big tech concentration, are you truly prepared to navigate a market where total diversification is just a myth? It might be time to take a closer look at those allocations. Thank you so much for joining me for this explainer, and remember to keep questioning what's really under the hood of your investments.